What if the next global economic weapon wasn't oil, wasn't microchips, and wasn't even rare earths? What if it was silver? Not the silver in jewelry stores, not the silver traded on Wall Street screens, but the industrial silver buried inside solar panels, electric vehicles, AI servers, missile guidance systems, and power grids. Because while the world was distracted by inflation data, rate cuts, and election cycles, China quietly changed the rules of the silver market. No embargo, no sanctions, no emergency headlines, just a policy shift. One that turned silver from a commodity into a strategic asset. Within months, prices didn't drift higher, they repriced violently, manufacturers panicked, supply chains tightened, and analysts began asking an uncomfortable question. Did the United States just lose hundreds of billions of dollars without a single shot being fired? When you hear the number $420 billion, it doesn't mean money vanished from the Treasury. It means lost production, higher industrial costs, delayed projects, permanent competitiveness damage, losses that don't appear all at once, but compound silently over years. This isn't speculation, this isn't conspiracy, this is how economic power works in the 21st century. And once you understand how silver became the choke point, you'll realize this story was never about metal, it was about leverage. To understand what just happened with silver, you have to understand a pattern that repeats throughout financial history. Empires don't usually collapse because they run out of money. They collapse because they lose control of critical inputs. In the 1970s, it was oil. In the 2000s, it was manufacturing. In the 2010s, it was semiconductors. Every era has a resource that quietly underpins everything else. Silver is that resource now. Historically, silver was money. The Spanish Empire ran on it. The British monetary system depended on it. Early American coinage was built on it. But when fiat currencies replaced metallic money, silver lost its perceived importance. That was the mistake. Because silver didn't disappear, it migrated. It moved from vaults into factories, from coins into circuits, from savings into infrastructure. Today, silver is embedded in nearly every system that defines modern economic power. Now here's the critical historical parallel. In the early 2010s, China restricted exports of rare earth elements. At the time, Western analysts dismissed it as a trade dispute. They were wrong. What China demonstrated was something far more important. If you control refining, processing, and export permissions, you don't need to ban anything. You just control flow. Silver fits that model perfectly. China may not mine the most silver, but it dominates refining, processing, and intermediate supply chains, which means it doesn't need to own the resource. It just needs to sit between producers and consumers. And the United States? The U.S. produces only a small fraction of the silver it consumes. There is no large strategic silver reserve, no domestic processing dominance, no rapid substitute. That dependency wasn't dangerous when silver was cheap and abundant. It became dangerous the moment silver was reclassified as strategic. History doesn't repeat, but it rhymes. And the rhyme here is leverage through dependency. Here's the twist most people miss. China didn't weaponize silver against the United States. It weaponized silver for itself. This wasn't retaliation. It wasn't punishment. It wasn't even aggression. It was insurance. China's domestic industries, solar, EVs, grid infrastructure, defense, are silver intensive. By tightening exports, China ensured that its own manufacturers would never compete with foreign buyers for supply. Everyone else would pay the volatility. And that's when the real damage began. Because once prices spike, companies don't just pay more, they change behavior, they delay projects, they stockpile inventory, they cancel marginal investments, capital stops flowing efficiently. And here's the cliffhanger. Most of the economic damage hasn't happened yet. The true cost shows up years later, in lost innovation, slower capacity expansion, and industries that quietly fall behind. The $420 billion figure isn't about yesterday. It's about what the next decade now looks like. And to understand that number, you have to understand the mechanics. Let's break this down the way economists do. First, silver prices. When silver moves from $29 to over $80 per ounce, that's not a marginal increase. That's a structural shock. Now apply that shock across industries. Solar manufacturing margins are thin. EV production relies on scale economics. Data centers require massive upfront capital. When input costs triple, companies face three choices: absorb the cost, destroy margins, pass it on, reduce demand, delay or cancel expansion. All three reduce economic output. Now multiply that effect across industries worth trillions of dollars. Even a 1-2% efficiency loss compounds into massive numbers over time. That's where the $420 billion estimate comes from. Not from theft, not from accounting entries, from lost potential output. Then add secondary effects. Higher prices reduce adoption of clean energy. Slower EV rollout impacts emissions targets. Defense procurement costs rise. AI and data infrastructure becomes more expensive. This is what economists call frictional loss. It doesn't make headlines, but it permanently reshapes competitiveness. And once supply chains reorganize, they don't snap back. That's the real cost. Not the price of silver, but the price of dependency. This story isn't really about China, and it isn't really about silver. It's about a world where power no longer comes from owning markets, but from controlling bottlenecks. The United States still has options. Recycling, domestic processing, strategic reserves, supply chain diversification. But all of those take time, and time is the one thing leverage doesn't give you. The lesson here is simple and uncomfortable. If you don't control the inputs, you don't control the outcome. Silver was ignored because it was boring until it wasn't. And the next strategic resource won't announce itself either. If you want clear, fact-based analysis on how global economic power is shifting, subscribe. Because the future of finance isn't about markets. It's about leverage.